We had some very interesting economic data come out this week. I'm gonna go over them in this video. I'm gonna talk about some signs of tops and bottoms in the market and look at some excesses and try to determine if we are somewhere close to extreme excesses or extreme greed in the market, or if maybe we're nowhere close to that and maybe the market can go much, much higher. It's something very interesting that I haven't done in a very long time. So I think you guys are really going to enjoy this video. Now, if we look at the CPI, it has been falling down a lot from 9.1% to around 4%, which is amazing, not just for the Fed, but also for our portfolios. Because if you measure your returns in real terms adjusted to inflation, you want a lower CPI, so you have a higher real return adjusted for, inflation. Now, what has not been falling down is mainly around the core PCE and core inflation. And this is what Fed Waller said. And he said it is disturbing that the core inflation is not moving, will probably require some more tightening. And if you look at where the core PCE month over month is pretty much it's at the same level where it was at in March of 2021. After 525 basis points of rate hikes, over 5%, 5.25%, we're still at the same level we were at in 2021. This is very, very sticky. This is going to cause a lot of problems, for the markets in the future, because it might mean that either the Fed has to hike more, or they're going to have to keep doing the balance sheet and taking on liquidity for longer, or keep interest rates for higher for longer, like they were talking about. And this is going to be very, very bad if this trend doesn't actually reverse. And it has not been reversing at all. It goes up and it goes down, but it's very sticky, and it's the same level where it was at in March of 2021. So there's no progress whatsoever around, the core PCE, and this is something to actually be, worried about. Now, what the Fed actually said, they said that they see the Fed funds rate at a median of 5.6% by the end of 2023, which the market didn't really buy it. And this is one of the reasons why the S&P kept going up, because Powell pretty much said they're gonna pause, but then they're gonna hike again 2 more times. And we saw what happened in 2018 whenever Powell said something close to that, but he stopped hiking. He eventually started cutting rate in 2019. And this is when the market took off, and then everything pretty much reversed. So the market is not really buying whatever Powell is saying here. And this is why pretty much the market is going up, despite Powell saying they're going to hike 2 more times. The market doesn't believe it. I personally don't really believe it. I mean, I think this is done. The Fed is done. I could be wrong, but if maybe, core PCE gets more sticky, maybe then they're going to eventually, rise it a little bit higher. But this will be, remain to be determined. But if we look at where the market is at right now, and this is the Fear and Greed Index, which I couldn't really care less about. But if you look at the VIX is at 13, the lowest since 2019 or 2018. But if you look at the Fear and Greed Index, we are at extreme greed kind of levels. And this can really be seen by the recent IPOs that came public. And this is a stock called Cava, C-A-V-A. And this is a US-based fast casual Mediterranean restaurant type of chain. It was priced at $22 per share. Now, you normally don't really want to buy IPOs, because whatever they price on the IPO is normally very, very expensive for the insiders and other kind of parties to sell out. So always you pretty much never buy at the IPO price. But actually Cava went way beyond the IPO price. It went from $22 per share, and it began trading at $42 per share. This is a sign and a huge signal of extreme greed in the market. And we have seen it many times before. We have seen it in 2021 with the IPOs, with the SPACs and all these kind of things, which actually leads me to where I'm trying to go. And this is a list that I put on my Twitter. You can follow me on Twitter and actually get this list. And this is a list that pretty much tells you the signs of tops and bottoms of extreme, pessimism or extreme optimism. And we're gonna go over some of those signs in this video. And most of you are going to recognize them because we had the same exact signs in 2021. Now, the first sign is large numbers of IPOs. We haven't been seeing that yet. Yes, we did see Cava. We saw, another kind of dating app. I forgot the name, what it was. And we saw a few of others, but we don't have like a large number of IPOs or SPACs like what we had in 2021. The second one is rapidly rising prices. We are having some of that. The third one is excess leverage. We don't have excess leverage. Margin debt is nowhere close to where it was in 2021. So we don't have excess leverage, availability of credit. We don't have availability of credit over optimistic front covers of newspapers and magazines. We don't really have a lot of it, although some are starting to post, but many kind of, magazines and newspapers are having doubts about this rally. They are trying to say maybe this is a bear market rally or stocks are gonna reverse. So we don't really have that yet. Very high trading volume. We don't have high trading volumes. We do have them on calls and stuff, but there were many stocks that were pretty much going up on low volume, which is not a sign of some kind of a top of something like what we had in 2021. Number 7 is historically high PE or enterprise value to EBITDA multiples. We are having historical high PE ratios. I think it's around 25 right now. The mean is 16. So it's way beyond the historical mean. Although, profit margins are higher, but it's still on the higher side pretty much of that. Number 10 is this time is different. I'm not hearing much of that, although I'm starting to hear it a little bit more that, this time was different, but I'm not hearing it as much as before. Number 12 is innovation leads to euphoria. We are having it within the AI kind of stocks, but I personally believe after looking at this list that we're not close to something kind of extremism or extreme optimism. Maybe once we get a little bit more IPOs, once we get, margin debt going back up, once we get availability of credit, once we get, over optimism on newspapers and magazines and high trading volumes, and you go to restaurants and you hear people talk about Robinhood and Dogecoin like I was hearing in 2021, then we could be close to the extremism. But what I'm trying to say in this video is that it's hard to make the case for the S&P to go higher. But all these indicators and all the signs are not here. And in fact, with something like Cava, it's going to actually entice many other companies to start going public. And then this is when you have more IPOs, this is when you have more extremism, but then the market even goes higher before it ultimately goes lower, which is why I don't recommend anyone to just pretty much blindly short the S&P 500, especially looking at this chart. It's a huge breakout. This is not something you want to short, but looking at all the indicators that we looked at in this chart, we're nowhere close to some kind of signs of excessiveness, even though we could have it in the AI stocks and Nvidia. But in the overall market, there are still many stocks sitting at 52-week lows. We don't have a large number of IPOs. Maybe we're gonna start to have them, but this is an early trend that's emerging, and maybe we could, even go much higher, like what happened to the DAX. The DAX, the German index, is actually sitting at all-time high, and it's pretty insane what the quick of a recovery it had from October. Now it's sitting at all-time high. Maybe this is where the S&P is going, and then we could have some kind of a blow-off top. It's very hard to tell, but I would say it again that something that most analysts and people are not paying attention to are student loan repayments, which they're gonna start in September for over 45 million people in the United States. I think it's 45 million. And this is an article that says the restart of student loan repayments, it will slash household spending by $15.8 billion every single month. Now, this is massive, massive numbers. Huge numbers. It's not a billion or two, it's 15.8 billion. And this is really going to cause a lot of the discretionary spending, the cruises, the airlines, all those things that you just want, you don't really need. I think it's going to be very, very affected, which is ultimately going to affect earnings. Now, the way I'm protecting myself against this is I'm trying to buy companies in industries that are sustainable, they are more resilient, kind of recession-proof kind of earnings. I'm not trying to get exposed to cyclical areas and discretionary areas unless, the price is extremely cheap. But this is what I believe will ultimately happen. And this could be the catalyst of the reversals that we're eventually going to have whenever you have student loans with payments resuming, and this is going to cause massive strains on the EPS estimate for the S&P, which has actually been going up over the past few weeks. So this was my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.